Hello and welcome. Today we are talking all about medical malpractice, and we have Jennifer Wiggins joining us from Aegis Malpractice Solutions. Jennifer is the founder and CEO. Prior to starting the company in 2018, she had worked for the nation's largest malpractice insurance carrier for 16 years. So I guess that means you have 20 plus years at this point, Jennifer. And she started Aegis because she realized that doctors really needed better advocates, somebody who was unbiased, knowledgeable, and could really help them navigate the world of medical malpractice insurance. So we're having a conversation today and hopefully answering all of your malpractice questions. Thank you for joining us, Jennifer.
Yeah, thanks so much for having me.
Well, let's just dive right in with just a real high-level definition. What exactly is medical malpractice insurance?
Yeah. So I think everyone pretty much has a good working definition, but sometimes it's a good reminder just to know that, malpractice insurance really is intended to cover doctors in the event of professional negligence. When that negligence results in harm to a patient, obviously that's the pure definition of medical malpractice. So you obviously need to have insurance to protect you in the event that you do get sued. And that way you have protection not only for paying for the claims, but also hiring the defense attorney, paying the court fees, getting expert witnesses to defend you, to say that the medicine that you provided was sound. Because at the end of the day, doctors are not expected to be perfect. They are human, just like everybody else, but they are expected to meet a certain standard of care. And so that's really the litmus test when it comes to malpractice is, did the doctor meet the standard of care? And the way that they prove that is by bringing in expert witnesses to be able to show that either the doctor did meet the standard or did not meet the standard. And so attorneys on both sides, both the defense and the plaintiff side, will bring in expert witnesses within that same specialty field to try to prove their point on either end.
Okay. It's one of those scary situations I think most doctors hope to never find themselves in, but good to know that we have malpractice and to cover us in that event. So one of the things I learned from your podcast, Jennifer, is that there are two types of damages in a medical malpractice case that a patient can seek to recover, either compensatory or punitive damages. Can you explain what those are, and are they both covered by malpractice insurance?
Yeah, absolutely. So those are the two main categories. So you have compensatory damages, which are covered by your malpractice insurance. And then we have punitive damages, which are not covered by malpractice insurance. And so I'll dive into those each just a little bit. So the first category is compensatory damages, and that's the most common type of damages that a patient will seek to recover. And there are two types of compensatory damages. There's economic damages and then non-economic damages. So economic damages are what we all have heard about. It's obviously the cost of medical expenses, the cost of future medical care. So if a patient is injured and they'll need long-term care, how much will that cost in the long run? It's obviously loss of income. All of those things that can have a dollar amount matched to them, those are economic damages, and those are covered by your malpractice insurance. There are also non-economic damages, which sometimes the court will also award. And these are like those intangible things that you can't really put a dollar amount on, but they still want to make sure the patient is awarded for. And so that would be like scarring, humiliation, loss of consortium, all of those things that don't have a direct dollar amount, but sometimes the courts will award if a patient has, something that falls into those categories as well. So both the economic and the non-economic are covered underneath your malpractice insurance. The other category, though, is those punitive damages. And so punitive damages are not super common. They're really only awarded in the event that a professional, like if it's absolutely negligent, like it was intentional, if you tried to hurt the patient, it was willful, reckless behavior. Like the only time I've seen this come up is if a doctor comes in and they're on drugs or they're under the influence and they really should not be practicing medicine. Sometimes we'll see punitive damages come in that regard, but it's very uncommon. We don't see it a ton. But when a court decides to award punitive damages to a plaintiff, again, punitive is to punish, right? So that's not covered by your malpractice insurance. If you do get punitive damages awarded, those actually have to come out of your own pocket.
Okay. Wow. So where does the pain and suffering come in? Is that the non-economical part of compensatory damages? Okay.
Yeah. And so that is covered by your policy. So all of those things come into play. They're all covered by your malpractice insurance. So again, it's really important that you remember that not only will your policy cover those actual expenses of what the patient is recovering, but they're paying for your attorney fees, they're paying for the court fees, they're covering those expert witness fees. So all of that is all looped in and is all part of the coverage that comes standard with most malpractice policies.
Okay. Great. Well, let's get into the types of coverages. The two main types, as I understand, are occurrence coverage and claims made. What's the difference between the two?
Yeah. So I answer this question probably 10 times a day, and it is still super hard for doctors to wrap their heads around it. So I have some visual aids that I'll use to try to help explain it. But the basic definition of this is this. So you have the two different types of policies, and the difference is how the coverage triggers. So when you have an occurrence policy, your malpractice insurance is going to trigger based upon when the medical incident actually occurred. So if you did surgery today, which is what, June 29th, right? June 29th, 2023. If something happens today, today is the occurrence date. If you have an occurrence-based malpractice policy, you will be covered based on the occurrence date. Even if the patient doesn't file a claim against you for another 6 months or another year or another 2 years, it doesn't matter when they sue you. It matters if you were insured at the time that you did the treatment, that the treatment was rendered. So occurrence policies trigger based on the occurrence date. The other policy type is claims made, and that triggers the complete opposite way. So a claims made policy triggers based upon when the claim is made. So in that exact same situation, if you did surgery today, June 29th, 2023, but a patient sued you January 1st, 2024, the triggering date is the date the claim was made, which would be January 1st, 2024. So you have to have malpractice insurance in place at the time of that triggering event in order for you to have protection for that particular issue. So occurrence policies are really simple because they're very flexible, they're very straightforward. It's really easy to remember. As long as I have insurance at the time that I treat my patient, I know I'll be covered for this no matter what happens down the road. A claims made policy is a little more complicated because you have to make sure you have protection indefinitely into the future, because you might have a patient that sues you 6 months from now, a year from now, 3 years from now, 10 years from now, but you have to have insurance at the time that the claim is made in order to have coverage for that particular event. So claims made policies, you'll often hear another term used in kind of tandem with that, and that's tail insurance. So a claims made policy is really two policies in one. You have to carry the insurance while you're working, but then after you're finished and you cancel it, you have to purchase tail, which starts on your cancellation date, and it covers you into the future in case you still have claims made after that policy has ended. That'll give you the protection down the road. So occurrence policies are pretty simple. They're just the flexible policy, only one, no tail insurance required. Claims made policies are really 2 in 1. You have to carry the insurance while you work, and you have to get tail at the end.
Okay. Well, that explains it. I definitely have heard a lot about tail insurance and, is my tail covered and who's paying for the tail insurance? So makes sense now that it's covering that event that happened under the claims made policy during a future date.
Yeah.
Okay.
Yep.
Well, so what are some reasons to consider occurrence over claims made or vice versa?
Yeah. So when we're helping doctors kind of compare options, I always quote both policy types because I think it's really important for providers to obviously look at the pricing differences between each, but then also look at kind of the long-term costs and what the real benefits are to them beyond the actual rate that you'll have to pay for the coverage. So occurrence policies, again, are nice because they're super flexible. You don't have to worry about the tail insurance. However, occurrence policies tend to be a little bit more expensive. expensive.
Mm.
So occurrence coverage is a very flat premium. Let's just say, for example, occurrence, let's just pick a plastic surgeon, let's just say in California, let's just say hypothetically, it's $15,000 a year for an occurrence policy. I don't know if that's right or not. I'm just throwing a number out for example. But if you have an occurrence policy, you'll pay $15,000 each year of your insurance. It doesn't have any huge peaks in terms of rate changes. It's a very stable premium. You will get discounts, obviously, that might fluctuate year to year, but for the most part, the occurrence premium is very stable. So 15,000, 15,000, 15,000, 15,000. It's nice because you can budget and you kind of know what those long-term costs will be for you. And that way you can just kind of know in your head, it might go up a little bit, but in general, it's going to stay around that same range. The other thing that's nice about the occurrence policy is each time you renew that policy, you retain the previous year's limits. So the coverage that you get on an occurrence policy is really robust. So I'm going to use my visual aids here because I think this sometimes makes it a little bit easier for doctors to understand. So when I try to explain how the occurrence policy works, I like to use like books on a bookshelf. So the occurrence policy, let's just say we have a doctor that starts January 1st, 2023. So it runs from January 1st, 2023 to January 1st, 2024. Malpractice policies run on an annual basis. They're 1 year at a time, just like most other insurance policies. And let's just say our California plastic surgeon has a 1 million, 3 million policy limit. That gives them $1 million worth of coverage per claim with a $3 million aggregate for that entire year. So you could have 3 $1 million claims and it'll all still be covered underneath the same policy. You could also have a bunch of smaller claims, but again, as long as it's under the 1 million per claim limit and as long as it doesn't exceed that $3 million aggregate, it would still be covered under the same policy year. So again, let's say this is our January 1st, 23-24 policy. So after I've paid for this, I take my book and I stick it on my bookshelf. I don't have to worry about this policy again, but I have it on my bookshelf in case I ever need it later on. My policy renews again the next year. Now I've got a new book. This book is from January 1st, 2024 to January 1st, 2025. And it still has that 1 million, 3 million policy limit. So it covers me for any patients I treated from January 1st, 24 to 25. I pay for it, I buy it, and then I stick it on my bookshelf. I don't have to worry about it again. So every year that you renew that occurrence policy, you're accruing books. You're buying your book, paying for your premium, putting your book on your shelf. You might need to use it later on down the road. So now let's just say there's a claim that gets filed, right? And it's for a patient that you treated on June 1st, 2023. Remember back to our explanation, the occurrence policy triggers based on the occurrence date. So what I do is I go back to my bookshelf and I pull out my policy from January 1st, 23 to 24, because this one will cover that date. And then basically whatever the claim gets paid, right? I open my book, I make my claim payment, patient is recovered, take my book, close it, put it back on my shelf. What's nice is all of these other years are fully intact. So I haven't even touched these policies in terms of the limits that are available. I still have 1 million, 3 million for 2024, 1 million, 3 million for 2025, 26, 27, and so on. The one policy that I did make a payment on, let's say it's a $200,000 claim. The limit for this is now $1 million, $2.8 million aggregate. Does that make sense?
Yes. Yeah.
So I've paid my $200,000. It doesn't reduce my limit per claim, but my aggregate has now gone down by $200,000. So I have $2.8 million total coverage for this particular policy year. So this policy still has plenty of good coverage. So I stick this back on my shelf. If I need to use it later on down the road, I certainly can. So when I'm pricing out occurrence options for doctors and I'm giving them the rates, it's really important that they understand the value of what they're buying, which obviously is the limits that stack up year over year, no tail insurance ever. So you don't ever have to worry about that. And it's a flat premium, although it's more expensive, it's a flat premium, which makes it easier to budget over the long run. So those are kind of like the reasons why you would choose an occurrence policy. It also obviously depends if it's available, because it's not available everywhere.
Oh.
And not every carrier offers occurrence policies. So when you're comparing, you might have your agent come back to you and say, here are your options. Carrier A, B, and C offer occurrence and claims made, but carriers D, E, and F don't have occurrence. So it's not widely acceptable with every carrier, but it's definitely something that you should consider when you're comparing your options on both.
Oh. That makes a lot of sense. I like the book analogy. I think that's really helpful to visualize how that works,
Yeah.
when those claims are made, and understand that what the policy limits are each year that you have that policy intact.
Yeah. I think it helps kind of like just in your mind know that, like, if you ever need to go back and grab those policies, you have them. So even if you, like, let's say you work for a group for 5 years and they had you on an occurrence policy, and then you leave and you switch, and maybe the new group you joined, or if you start your own practice and now you're going to buy a claims made policy, you still have those books that you can go back and grab later on if you need to. Sure. They don't go away. Okay. So, it's very, very common throughout your entire career that you may have periods of time where you have each different type of insurance. So it's just kind of nice to know how those work down the road if you need to access them.
Yeah. Well, that really makes a lot of sense.
I'll jump into claims made if you want, but I don't want to rush you. If you have
that's where I was going to go there next, just to say,
okay.
So what are the reasons to consider a claims made policy instead?
Yeah. So usually at this point, after I've explained occurrence, everybody's like, oh my gosh, well, of course I'm going to buy occurrence, right? Claims made is just as good. It's perfectly fine, but it does trigger differently. So remember, we talked the claims made policies trigger based on when the claim is actually made against the provider. And the limits for a claims made policy are also different in how they're structured. So you don't get the individual policy limits that stack up on your bookshelf like you do on the occurrence policy. I actually use a rubber band when I'm trying to explain how claims made limits work, because claims made limits stretch over the duration of the policy term. So let's just use that exact same example. We have our plastic surgeon in California that they start their practice January 1st, 2023. So imagine I have like a pegboard, right? And I've got a peg that I'm dropping in my pegboard on January 1st, 2023. This is the inception date of your policy. This is also called your retroactive date. So any future filed claims that would ever be made against you, this policy will cover you for any patients you've seen back to this date. So if you've ever heard somebody say, what's your retro date? That's what it is. It's the inception date of your initial claims made policy. So the first year you have the insurance, it's just like the occurrence. It runs for a full year. So I've got January 1st, 23 to January 1st, 24. And let's just say I still have a 1 million, 3 million limit. Okay. So I have the rubber band that visualizes the limits that go from the first of the year to the end of the year. So now I renew the policy. So now my policy goes January 24, right? 24 to 25. So now my limits extend 1 more year. I still have the same exact retro date. So I still have my retro date is January 1st, 2023. But now I have 2 years worth of patients that I've seen, and I have 1 million, 3 million limits that cover me for that exact period of time. So 2 years worth of work, 1 set of limits. I renew it again. And now I'm up to what? January 1st, 25 to 26, 1 million, 3 million limits, same retro date, but I have 1 million, 3 million for any claims for patients that I've seen during this period of time. So sometimes I'll have doctors that say, holy cow, that's not very much coverage. What happens if I get sued? Like I have that $200,000 loss against me. What happens? Well, every time you renew that policy, the limits refresh. So if you did have a loss against you, you'd still have coverage for it. It would pay just like the first example paid. And then when your policy renews again the next year, you get a fresh set of 1 million, 3 million. So it doesn't stack up, but it does replenish itself every single year that you renew. So again, you renew it, you renew year over year. You still have one limit for that entire period of time. And then when the time comes that you have to cancel, that's when you have to secure tail insurance. So let's say this provider works for 5 years, and after 5 years, they cancel the policy and they're going to go do something else. So I'm going to drop my final peg in after 5 years. So now I've got my retro date here, I've got my cancellation date here, and now you've got to buy tail insurance. Tail insurance typically costs 1.5 to 2 times your premium. So let's say that a mature claims made policy costs $14,000, right? You can expect to pay 2 times that roughly for your tail. And the tail is just a one-time payment. You only buy it once. It doesn't renew just like a normal policy does. It's a one-time payment. And when you buy it, you'll get an endorsement from your carrier, and it'll say, we cover you for any future filed claims for patients you treated from this retro date until this cancellation date. And you've got a 1 million, 3 million limit for the entire period of time. So if a claim is filed, the day after you cancel, the tail activates. If a claim is filed a year after you cancel, the tail still activates. There's no expiration date on your tail, assuming you buy what's pretty standard, which is an unlimited tail. It covers you indefinitely into the future, so you don't ever have to worry about it going away. So that's the main difference when you're talking about coverages. You have the stacked versus the refreshed limits. But the other big reason why people choose claims made is that it's cheaper. So claims made policies, because of how they trigger based on when the claim is actually made against you. So all of those really smart actuaries that work at the malpractice carriers, they've determined that the risk the first year that you're in practice is really small, because the chances of you having an incident and getting sued within your first year is relatively low. So your first year claims made premium, let's use that same example. So if our occurrence is $15,000 a year, your claims made first year premium might be $7,000, right? So when I give a doctor the quotes, I'll say, here's $15,000 for the occurrence and $7,000 for the claims made. Of course, people are like, I'll take the claims made, right?
Yeah, seems like a no-brainer.
Seems like a no-brainer. But the problem is that's not the long-term premium. That's only the premium for the first year. So it starts at 7, and then it might jump up to 9,000, and then it might jump up to 11,000, and then 13,000. It basically steps up every single year for 5 years. Once you've reached your 5th year on the claims made policy, then your premium is considered mature, which basically means it doesn't step up anymore after that. So the 5-year premium is generally like 5 to 10% cheaper than the occurrence premium. So if the occurrence is $15,000, the claims made mature premium might be $13,500 or $14,000, but they're very comparable once you get to that 5-year mark. The kicker then is you've got to buy your tail, which is 2 times the mature premium. So if it's $14,000 for your mature claims made, then you're looking at $28,000, $27,000 for your tail. But what's really interesting is most malpractice insurance carriers do have a few exceptions where doctors can actually qualify for free tail insurance.
Oh, wow.
So yeah, so you can get free tail insurance in 3 general ways. The first is death. So if something happens, you pass away, your malpractice carrier will pay for your tail. So no tail in the event of death. The second thing is in the event of disability, and this could be injury or illness. So a doctor gets cancer, no longer able to practice. A doctor has an injury affecting their hands and they can't do surgery anymore. If you become disabled and you're no longer able to practice medicine, most of the time the carrier will also give you free tail for that. And then the third most common one is in the event of retiring. So if you carry your claims made policy for the duration of your career, so you carry it all the way until you're ready to hang it up and be finished, you'll get a free tail when you're permanently retiring from medicine. Now, you can't retire and then go do some 1099 work or retire and go do locums or go volunteer at the free clinic. You have to be permanently retiring. But once you do that, you actually can earn a free tail. So for solo practitioners or doctors that own their own practice, claims made is very, very popular because most of the time they anticipate doing this until retirement.
Right.
And so they, understanding the main differences between the two policy types, a lot of times they'll go claims made because they want to take advantage of those early year discounts. And then they're, crossing their fingers that they're going to stay doing this until the long run, and then they'll get their free tail at the end. So I would say it's probably 70% claims made, 30% occurrence when we're quoting out coverage for new providers. But again, it just depends on that person's particular situation, right? Some people have been burned by tail insurance before and they do not want to deal with it again. And so occurrence is super appealing to them because they're like, I just don't want to have to stress about it. So it just depends on each unique person's perspective, what they're thinking about doing in the future, what the availability is in the markets where they work. So those are the main differences and why you might choose one over the other. And there's no right or wrong, obviously. It's up to each unique person's needs and wants.
Thank you so much for that definition and explanation. That makes so much more sense. And I definitely can see why a surgeon starting a new practice would find the claims made appealing, just from, it's so expensive, right? We're spending money on so many things in those early months and years that it seems like a way to potentially save money while also having appropriate coverages, not skimping. But speaking of skimping, I do have a friend who practices in Florida, and she decided to go bare. And I was completely unfamiliar with this. In fact, I think I called you and said, Jennifer, what does this mean? What is she doing? Is this a huge risk? Can you tell us more about what it means to go bare?
Yeah, this is super popular in Florida because Florida is one of those states where, unfortunately, there have been a number of carriers that have pulled out of the market or carriers that have raised their rates to the point where it's just really unaffordable for a lot of doctors to practice medicine. So if a doctor chooses to go bare, that just means they choose to forego malpractice insurance. Now, Florida actually allows doctors to do this. And I can't remember exactly what the specifics are, but I think it's at least two things I know for sure. Number one, I think you have to make sure your patients know that you're practicing without malpractice insurance. And secondly, I think you have to be able to prove that you can, I think it's like a $200,000 bond or a $300,000 bond. Basically, you have to prove that you have the financial ability to pay for a loss or help a patient recover in the event that you do get sued. So you have to be able to show financial responsibility. You have to be able to communicate that to your patients. Now, Florida, again, has allowed doctors to do this. There are other states where you cannot. There are other states where you're required to carry malpractice insurance, but it is common to go bare in Florida, especially in certain areas where the rates are really, really high, like Miami, West Palm. Those areas are just really, really expensive. And so it can be cost prohibitive for doctors who want to practice there. And so if they want to take the risk and go bare, they can certainly do that. The one thing that I do always tell people, though, if they choose to go bare, is it's harder to flip if you change your mind. So if it's a big commitment, so if you do decide to go bare, you just need to know what that means for you down the road. So let's say you go bare for like 3 or 4 years, and then you're like, man, I just don't know that I want to do this anymore. Rates are coming down a little bit. I think I'd like to go ahead and buy insurance again. It's going to be very difficult for you to actually find a carrier that's willing to offer you new insurance after you've been uninsured for that amount of time. So just keep that in mind. It might make it more difficult for you if you do want to explore options in the future. I'm not saying it's impossible, but it does make it a little bit more difficult because in the carrier's eyes, you're high risk, right? Because you've been practicing without coverage. And if something were to come in, they could potentially get looped in. So it makes it a little bit more difficult. Not impossible, but a little bit more difficult.
Okay, that makes sense. Scares me a little bit, but understand the motivating factor and particularly around those malpractice premiums. So how are premiums calculated? What are the factors that go into that?
So it's a combination of lots of different factors, right? Just like your car insurance, your homeowner's insurance, they're looking at the make and model of your car, what your house is made out of, how close you are to the fire stations. malpractice insurance has a lot of those other kind of interesting little data points, which is what the underwriters will use to calculate your rate. So first of all, they're looking at your specialty. They want to know specifically what you're doing. So plastic surgery is unique because a lot of carriers have special classifications if you're a facial plastic surgeon versus if you're a traditional full body plastic surgeon. A lot of them also have cosmetic surgery rates that are slightly different. So with all of the nuances in plastic surgery nowadays, there are kind of a little bit more deviations in rates that can make it more appropriate for what you're actually doing. So first of all, they're looking at your specialty. Second of all, they're looking at where you're practicing. So again, it's back to that whole, are you in Miami, Florida, or are you in Omaha? I mean, where are you practicing medicine has a big factor in how much you're going to pay. I mean, you can see plastic surgery rates go from 6 figures all the way down to, $6,000 a year, depending on where you're practicing in the United States. So that has to do with obviously the jurisdiction, right? If you're in a place that's super like sue heavy, they just go after doctors all the time, or if you're in an area where courts just tend to be a little bit more sensitive to the patient's wants and needs. Doctors unfortunately can get sued often and oftentimes get sued for more in certain areas of the country. So specialty, location. The third thing is obviously your policy type. So occurrence versus claims made. Your limits is the other thing they're going to take a look at. So how much coverage do you need? Obviously, the higher the limits, the higher the premium. The lower the limits, the lower the premium. And then the last factor really is your effective date. So malpractice carriers, their pricing is regulated by the Department of Insurance in each state that they do business. And they have to report their rates to the Department of Insurance every single year in order to stay compliant. And that also just makes sure from a competitive perspective that there's not some carrier gouging and charging way too much, or some carrier charging really, really low rates, which might mean that they're financially foolish, I guess, like not charging enough to make sure that they can actually pay for claims down the road. So all of those things are regulated by the Department of Insurance. So carriers will tweak their rates every single year based on the trends and what's happening in the marketplace. So your effective date can have a bearing on how much you pay, because if the carrier has just taken a rate change for that year, your price may go up, your price may go down. So that also has some bearing on that. Once they determine what your actual manual premium is, or like your baseline premium, then you can qualify for other discounts and things that can help reduce your price further. So if you're part-time, that'll help reduce your price. Loss-free credits, claim-free credits. So the longer you're in practice without having a claim, or the longer you're in practice without having a loss against you, you'll get, discounts and things for that as well. If you take risk management courses with the carriers, they'll also give you credit. So there's a variety of other things like that that can help bring your premium down to a little bit more affordable level based on how good of a risk you are to the carrier. And so those are the different things that they're going to look at.
Okay, that's helpful. Is there a certain percentage that a surgeon can anticipate their rate to increase each year, or is it really variable year over year?
It's variable year over year, and it's dependent on a couple of different things. Now, first, it's dependent upon the carrier's experience overall, right? So is the carrier experiencing higher claims with that particular specialty, or are they experiencing more claims in that particular geographic area? Like, it's not uncommon for a carrier to say, hey, we need to raise our rates in Miami, Florida, but we're not going to raise our rates in Fort Lauderdale, right? So it could be very particular to the geographic area. It could also be very particular to the specialty. So if they've had a ton of claims for cosmetic surgery for some reason, they could just raise the rate for cosmetic surgery and it wouldn't affect the other providers. So there are those types of nuances by the various kind of categories. But it also is dependent upon the provider's individual experience. So if you've had a claim or something has changed that might make your risk higher than it was the previous year, then you might see an individual rate change just based on what's different this year versus last year with your individual practice. But for the most part, there's really not any general rule of what you can expect for rate changes unless you're within those first 5 years of the claims made. And in that instance, we can pretty accurately tell you projections of what you might see in terms of your second year, third year, fourth year, fifth year step increases. So those types of things we can budget a little bit more easily, but the other things are kind of out of our control.
Okay. Okay. So I think most surgeons are pretty clear they need their own individual policy, right? Covering the patients that they are personally treating. But talk to us a little bit about what an entity policy is and when should we consider purchasing that in addition to the individual?
Yep. So almost always a provider should get an entity policy in addition to their individual policy, because the patient will sue you and they will sue the name on the door. So if you are your own LLC, you need to make sure your LLC is also covered. If your, LLC is not your name, but it's a practice name, the practice name needs to be covered as well. Entity coverage is very, very common. It's very simple to do, and it's also very, very affordable. There are two ways you can cover your entity. First, you can do it on a shared limits basis. So if you're a solo provider, you're a solo surgeon and you have an LLC and it's just you in the office, you're the only provider, you can actually share your policy limits with your LLC at no additional charge in most states. So that simply means, like, let's say, again, you had that 1 million, 3 million limit. That would mean that it covers you and it covers your LLC. So if something were to happen, you would be sharing that limit between yourself and your practice. So that's the first way to do it. And again, shared limit coverage is generally free because it's just endorsing that entity underneath a policy that you're already paying for.
Okay.
If, however, you're not a solo provider, if there are 2 of you, 3 of you, 4 of you, or more, you cannot do that shared limit. Shared limit generally is only available for solo doctors. Sometimes it's available for partnerships, but otherwise the shared limits is only available for those single providers. So the other way you can do it is to actually get a policy for the entity. So the entity policy is a separate policy. So you'd get, the 1 million, 3 million for yourself, and the 1 million, 3 million for your business entity. But obviously at that point in time, then you're paying a separate premium. But the premium, again, is not astronomical. It's generally 10% of your rate. So if you're paying $15,000 a year for yourself, your entity policy is probably $1,500. So you can get an entity policy that would cover the business name and then all employees that are also working underneath it. So the nice thing about getting an entity policy that is separate, not that's shared, but that's separate, is it kind of functions as like an umbrella for all of the other employees and staff that would be working for you as well. So if, heaven forbid, a patient sues the receptionist because she didn't deliver a message timely, or they're suing the medical assistant because something went wrong in the initial exam room, the entity policy will cover all of those providers on a shared limits basis. So again, that 1 million, 3 million for the entity trickles down to anybody else that's working on behalf of the practice. That includes nurse practitioners, physician assistants, and higher level providers as well. Now, those providers can also get their own insurance if you want them to do that. And sometimes doctors will ask, especially if you've got an advanced practitioner that's doing a ton of procedures and things on their own, you might want them to have their own insurance. But if you don't, they can be covered underneath that entity on a shared limit basis. But it's always important that you're kind of gauging how many people are underneath the entity. So that way you can kind of determine, okay, we've got a lot of people covered under this. It might make sense for us to pull out 1 or 2 of our higher level providers and set them up separately. Doctors can't be covered under the entity. Physicians and surgeons always have to carry their own insurance, but the entity can cover any of those extenders or APPs that you might have working with you.
Okay, well, that's exactly what I was going to ask about APPs, because I feel like in my experience, most have their own policy, or is it possible that they're covered under the doctor's individual policy? Is that a scenario that happens?
It's not usually, because physician policies can cover like RNs, estheticians, medical assistants, but they can't cover advanced practitioners most of the time. And quite frankly, it's not really wise to do it that way. It's it's you either want them to be covered under the entity or you want them to be separately insured. So it's usually not very common to do it that way. Most carriers won't let you. In fact, there's an actual exclusion endorsement on your policy, my guess. If you're one of these doctors in this specific scenario, I'll bet you your policy has an exclusion, whether you know it or not, that says that your policy will not cover any extenders working underneath you unless they're in those other categories.
Okay. So a surgeon starting out who maybe has a receptionist, a medical assistant, or a nurse, and an esthetician, we don't need a separate policy, either or. Are those individuals covered under the entity policy and or under the physician's policy?
Correct. Okay. Yep. So if it's a solo provider, you can just get one policy for yourself. You can share your limits with your entity, and all of the individuals that you just named would be covered underneath that as well.
Okay. Great. That's helpful. So in the process of shopping for malpractice insurance, and I worked with you with a couple of different surgeons, and I know you get a lot of quotes. And as you mentioned, you try to get the occurrence and the claims made, and we have all of these options now to consider. Where do you start? How do you compare the options and determine what's going to be the best policy for that practice?
Yeah. So I think this is really important. I think it's one of the most crucial things you can do right as you're getting ready to start practice, because you have all the time to now kind of really make a good decision on where you want to go. But it's not permanent. So also remember that even if you pick a carrier today, that doesn't mean that's the carrier you're married to for your entire career. So if you pick someone today and they're the right fit today, in 2 or 3 years, if something changes, you can always pivot and switch to a new carrier down the road. So when you're looking at pricing between carriers, obviously you want to make sure you're getting apples to apples comparisons, right? You want to make sure you're looking at the same policy types, the same limits, all of the various things are equal among all carriers. But besides price, there are a lot of other things that can be really important for a provider to make sure you're considering, especially if like 2 or 3 are really close in price, right? So why would I choose carrier A over carrier C? So there's a number of other things that we suggest that doctors take a look at. The first thing is, how long has the carrier been in business? Are they an established, financially secure, A-rated carrier? So all of the large A-rated carriers are regulated. They AM Best takes a look at their financials every year. You want to make sure that you're with an A-rated carrier or higher. There are A's, there are A pluses, there are A plus pluses. I would be very wary of anything that was B or lower, because that simply means that that carrier may not have enough financials for long-term viability. So I'd be very cautious committing to a carrier that isn't, certainly going to be here in the long run. So I would take a look at that for sure. I would also want to know what states does the carrier cover, because most plastic surgeons aren't doing telemedicine, but if for some reason you do have any opportunity to work in multiple states or have exposure outside of your primary practice, you want to make sure you know what other states the carrier covers. There are national carriers, there are regional carriers, and there are state-specific carriers. So it's important, I think, that you just know if you're committing to a state-specific carrier, you just need to know that so that you know really what they can and can't cover in the long run. I think it's also important that you take a look at their trial win rate. So how often are they winning when you do get sued and you do go to trial, because chances are it will happen at least once in your career. You might also want to know what defense attorneys they use. So if you have a particular defense attorney that you really like, that maybe you've used in the past or that you really trust, you might want to know if they're on the carrier's panel or if you have the ability to opt in for them, if you would rather use them versus if the carrier just has like a set number of panel members. You want to make sure you know that as well. I think it's also important that you take a look at some other policy nuances like consent to settle, which is really, really important for providers. So you want to make sure that your policy has a pure consent to settle provision. And what that means is that the carrier is not allowed to settle a claim without your permission to do so. And this happens, I think, more often than doctors really realize is, if you're with a carrier where there is no consent and you get sued for malpractice, If the carrier doesn't want to take it to trial and they just want to settle it and write a check and be done, they can do that. And if you don't have consent to settle, they don't have to get your permission to do so.
Oh, wow.
And that's a fairly big deal for doctors, because if you get a claim settled on your behalf without your permission, it goes on your record, right? It gets reported to the National Practitioner Data Bank. It's now on your file. So every time you go get privileges at a hospital or you go to get credentialed, it's going to show up. You pull your claim history report, it's going to show up. So it's just important, I think, that doctors know that they are in the driver's seat in terms of how they want their claims to be managed and settled. Sometimes settlement is the right answer, and I'm not suggesting that it's not. I just think it's important that doctors are the ones who decide, yes, let's settle, or no, I want to fight this. I didn't do anything wrong. So make sure your policy has consent to settle. So make sure you're looking at that when you're comparing all of your various options. Outside of those things, I think it's just good to take a look at what other features and benefits, do they offer risk management services? Do they have dividend payments? Like, there are some mutual malpractice carriers where doctors actually become owners and they get a dividend each year. So that might be helpful to know. So other things like that, just kind of extra touchy-feely things, that if there's 2 or 3 carriers that are really close, sometimes features like that are really important, and they might help you pick one carrier over the other.
Okay, that's helpful. So not just price alone. Price is important, but lots of other factors to really weigh in. So in general, how long does it take to shop for this new policy? And particularly a new surgeon who's thinking of starting a practice in the next 3 to 6 months, how much, when should they start that process?
Yeah. So I think it really depends on how quickly you need something. So I have a lot of times I'll talk to doctors who are 6 months plus out, and they're not ready to buy yet, but they at least need some initial numbers so that they can start budgeting and figuring out how much is this really going to cost. I even will talk to providers who are still like confidentially with an employer, and they're just exploring things and trying to figure out if they can even afford to launch and go out on their own. So you can absolutely at any point in time get confidential quotes that are non-bindable, just to kind of give you an initial idea of what the marketplace looks like. So you can do that at any point in time. If you are ready to actually go ahead and apply, and you need proof of insurance and you're ready to roll, then the timeline, obviously, we can tighten up a little bit more. So either way, I would say it takes on average 7 to 10 days to get quotes back from most carriers. But I always tell doctors to give yourself 30 days to get your insurance set up beginning to end, because the process really is fairly straightforward. So the first thing is you have an agent or a broker shop around for you. They're going to collect all of the various quotes. They're going to give you your summary of each of the different carriers, different policy types. You'll have a conversation then to pick which one is the right fit for you. That takes 7 to 10 days, give or take. Then you're going to fill out an application with the carrier that you actually want to go ahead and move forward with. That carrier's application process varies by company, but on average, assume it takes about a week, maybe 2 weeks, depending on if they have follow-up questions or if they need further clarification. Once you've applied, if you get approved for coverage, then you will review the final terms of the quote, make sure it's exactly what you want, and then you'll bind coverage and you can get your proof of insurance. So again, I say 30 days, but I'd say 3 weeks-ish. Is roughly how long it takes. If you need it to be quicker, obviously the timeline can be tightened up, but I say 30 days is a good guideline. Now, the other thing to keep in mind too is that carriers can only approve malpractice insurance applications up to 90 days before you're actually set to start working. So if you're not planning on starting until the end of the year and it's June, we can get you some initial quotes, but you just know that, again, those rates might change between now and the end of the year. So you can kind of get some initial numbers. You can kind of clarify a little bit. I'm interested in these 2 companies, but you can't really firm up your rates and officially apply until you're within that 90-day window.
Okay, that's helpful. And so even if you're in that 90-day window, can you choose a future effective date?
Yes.
Okay.
Yep. And we even have situations where sometimes we'll have doctors who need proof of insurance ASAP because they're trying to get set up with the payers or they're trying to get credentialed somewhere. And sometimes they're not planning on working for 3 or 4 more months. And so they're outside of that 90-day window. So when something like that happens, we do what's called a pre-approval process. So we still have them formally apply. We send it to the carrier. We make sure it meets all the guidelines. And then we can actually issue a certificate of insurance with like a temporary policy number as a placeholder so that you can go ahead and get going with the payers, get credentialed, have your proof of insurance. But then we won't actually turn on the policy until you're within that 90-day period of time. So you can request a future effective date and you can have insurance approved, up to 90 days in advance. You don't actually have to pay your premium until you're within 30 days of your start date. So you don't have to worry about a huge outlay of cash if you're still 3-4 months from actually starting working.
Okay, great. There is so much to this. I can't imagine navigating all of these options without an agent. And so obviously that's clear to me, one of the major benefits of working with an agent like you, Jennifer, rather than going directly to a carrier. What are some of the other reasons, though, that a surgeon should consider using an agent to guide them and coach them on these decisions?
Yeah. So interesting. You mentioned early my initial career, I did work for one of the carriers and I really enjoyed that. But what I realized was, when you go directly to a carrier, that carrier rep is only going to be able to give you a quote for that specific company. And they have a vested interest in trying to get you to buy from that specific company. So, it's really hard to make sure you've got somebody that you trust that's going to give you an unbiased opinion of all of the various options. So that's really where brokers come in. And I think that's the true value. On top of giving you kind of like an education of here's all of the various companies, here's what's different about each of the companies. It also gives you, I think, it's a time saver, quite frankly, because if you were to work with each company individually, you're working with 5 or 6 different people who need 5 or 6 different pieces of information from you. It would be very difficult to stay on top of managing that process. It's confusing enough just working with one person. Working with 5 or 6 would make that much slower and much more of a headache. So having one point of contact who also can be your advocate with the carriers and really making sure that you're getting the best price possible with each of the different marketplaces, I think is really important. So in my opinion, working with a broker just makes sense. But the one thing that I will say is make sure that it's a broker that really understands medical malpractice, because there are a lot of insurance agents out there and they'll do all different types of insurance. They'll do your business owner's policy. They'll do your general liability. They'll do your work comp, your life and health, all of your other things. And that's fine, but they really you need to make sure they have an expert that understands med mal, because otherwise you're going to end up with partial knowledge. And quite frankly, you're probably also going to have partial access, because malpractice carriers do not let any agent off of the street work with them. You have to meet a certain amount of criteria. You have to be experienced. You have to show your credibility. So if you work with an agent that is not knowledgeable and experienced in the marketplace, you might have an agency that only works with 1 or 2 carriers. And that's not any better than it would be if you were to just go to the carriers directly. So you really want to make sure it's a broker that understands med mal, but also has access to the entire marketplace and is really going to be able to give you the unbiased, objective opinion of what's going to be the right fit for them. And quite frankly, it's also nice too to have somebody say, you know what, I know the underwriter at this carrier, they're actually really easy to work with. They're really flexible. To kind of get that kind of behind the scenes information might help you make the right decision and make sure you're lined up with the right carrier.
Okay, great. That makes a lot of sense. So I often tell the surgeons I work with that they should never be afraid to ask any vendor or advisor how they make money. That should be transparent. So how do malpractice insurance brokers get paid?
Yeah. So doctors don't pay agents or brokers anything, or at least they shouldn't be paying them anything, because they make a commission from the carrier that they place the business with. So malpractice insurance carriers basically earn a commission from whichever carrier they place the policy with. One of the things that I think it's important that you really know is, and we disclose this if people ask us to, is what commission do you make with each carrier? Because I think that's another level of credibility, just to be able to say that, you know what, this carrier pays me 12%, this carrier pays me 8%. And that way it's very clear that they're not just steering you in the direction of, I'm going to make the most money if you pick this one. But they do make a commission from the carrier based on the business that they put with that company. One thing I will mention on that though is working with an agent or a broker doesn't change your price. So you're going to pay the same premium, whether you call the company and work with them directly, or you work through an agent. They don't differentiate their rates between the business that they sell directly versus the business that they sell through a broker. So you're going to pay the same price either way. I would actually argue that you probably will pay a little bit less if you work with a broker, because you also have the benefit of competition. So you're going to allow that broker to kind of really whittle down the prices as they're working with each market, because each of those carriers are competing against each other, right? And so now you've got an agent that's really going to help quarterback that for you and make sure you're getting the right rate.
Okay, great. You have shared so much information. I know we crammed a lot into a short amount of time, but it's super helpful, very valuable. If there's just one thing that you want people to remember from our conversation today, what's the most important takeaway?
I would say just make sure you're educating yourself upfront in terms of your different coverage options, and you're very clear on what that looks like in the long run. So what I don't want is for you to get an occurrence quote and a first-year claims made quote and commit to a claims made policy, not knowing the long-term costs of that. So I think just taking the time day one to make sure you're really comparing your options and finding the right fit for you is probably the most important thing. It's the easiest time to do that as well, because, you know, the world is your oyster. You have not plenty of time because there's a lot to do when you're setting up a practice, but it does allow you to kind of take a little bit more of a breath and really compare and educate yourself. And that way you're set up for success in the long run.
Okay, terrific. Well, one of the reasons I enjoy working with you so much is the education piece, that you're always willing to have these conversations. We will certainly link your website and podcast with this video, because Jennifer has created a ton of content, a lot of education videos and blogs on everything related to medical malpractice. So thank you so much, Jennifer. This was such a huge benefit having you here today. We really appreciate you.
Sure. Thank you so much.